Hello and welcome to the first video of the 12 Days of Crop Insurance brought to you by Jones Bank, where we believe in integrity, service, and community. I am your host, Ben Spirk, and today we will be discussing crop insurance, specifically looking at unit structure and the differences between a basic unit and an optional unit. So let's go a bit further when we're discussing the differences between a basic unit and an optional unit. A basic unit you only qualify for if you farm in one section only. Unfortunately, even if there's multiple fields, you still only qualify for a basic unit if they're all located inside the same section. Now, if you farm multiple fields across multiple sections, then you qualify for optional units. The big difference between basic and optional units is really when it comes to production and how it gets reported. As I said before, in a basic unit, even if you have multiple fields inside the same section, all of the production gets reported together. You don't get to separate out based on the fields. Under optional units, you do get to separate out that production based on the fields and where they're located. How this helps is if you have really good fields, they stay on their own under optional units, and really bad fields stay on their own, and they don't get lumped together, which means if you have the bad field, which has a couple good years and then it usually has a bad year, that bad year won't be offset by the really good field that always produces extremely well. And that's really the big difference between basic and optional units. So thank you for joining us on our first video of the 12 Days of Crop Insurance, where we looked at the differences between basic and optional units. There is one other unit structure called enterprise units, but we're going to make another video about that just due to the uniqueness of enterprise units. As always, I am Ben Spirk with Jones Bank, reminding you to be well, live well, and insure well.